This is one of the most easiest confluences you could use that will transform your trading. Smart money technique, also known as SMT divergence. We are able to use SMT with positively correlated assets and inversely correlated assets. For example, have a look at ES, aka S&P 500, and NQ, also known as Nasdaq. They are positively correlated, so when ES is bearish and creates lower highs and lower lows, you would expect NQ to follow through and create lower highs and lower lows as well. However, sometimes there is a divergence where ES creates lower highs and NQ implements a higher high. This is known as your SMT divergence, and this would increase the chance of price going bearish. One key thing to note is when you are anticipating bearish price action, you are focusing on the highs, and when you are bullish, you are focusing on the lows to hunt for your SMTs. Moving on to another example, this time it is with two inversely correlated assets, EU and DXY. Same concept here, but obviously it is inverted. When EU creates a lower high, you would expect DXY to create a higher low. However, like the previous example, there are times where you don't get that, and DXY creates a lower low. And that, ladies and gents, is your SMT divergence again. Now, you can anticipate EU to go bearish. This is a real chart example. Look at how ES fails to create a higher high, whereas NQ creates a higher high. This is your divergence, and you could then anticipate bearish price action, which is confirmed with your market structure shift. Now remember, SMT shouldn't be used as a confluence on its own, as they appear everywhere. Ideally, you should be using them as an additional confluence to your already existing plan. Like always, hunting for SMT in line with your bias will always be a higher probability. Now that we are able to identify SMTs, I will now show you how you could utilize them and a couple more examples to reinforce your understanding. So, like I said earlier, SMTs should be used in conjunction with your already existing plan, and they shouldn't be used by themselves, because SMTs could play on both sides of the market, so hunting for just SMTs will mess up your trading. Here we are on the weekly time frame. On the top chart we have NQ, and on the bottom chart we have ES, which is S&P 500. As we know from before, these two assets are positively correlated. On ES, we have this weekly FEG, so let's mark that out. And because we're bullish on the weekly time frame, you would expect a retracement back into this FEG before continuing higher. So let's go down onto the daily. Playing price action out, you can see here that no SMT has formed yet. So let's play out further. And as you can see here, AES made a lower low, whereas NQ failed to make a lower low. Instead, it made a higher low, and that is where you have your SMT divergence. Because it's happening at the low, this indicates that we could now anticipate bullish price action. And that was what we had. So let's continue playing this further. As you can see here, NQ failed to make a higher high, whereas ES made a higher high, and that is another divergence. However, if you remember from what I said before, SMT should be used with your plan and in line with higher time frame direction. So because on the weekly we have a bullish trend, we would not anticipate bearish price action from here. Instead, we would expect this SMT to not hold. And hence it doesn't. Looking at another bullish example, on the weekly time frame we're in a bullish trend, so now let's go down to the daily and play price out and hunt for SMTs that happens at the low as we are bullish. So as you can see here, NQ creates a lower low, whereas ES fails to create a lower low, and instead it creates a higher low. Yet again, that is your SMT divergence. and now we could anticipate higher price action. And that was what we had. Now let's look for a bearish example on the higher time frame, as this could also be used on the higher time frame to assist with your overall direction. So staying on the weekly time frame and playing price out. You can see here that on NQ we created these equal highs. This high was intact. However, on ES, the same high got broken with this higher high. And that is also considered your SMT divergence. Even though here we have equal highs, as long as the high that we are interested gets taken on either assets, that is considered your SMT for bearish price action. The same thing for bullish price action. If the low that we're interested in gets taken on either of the assets, that is considered your bullish SMT, regardless if there are equal highs or lows. Now that we can anticipate a bearish price action, let's keep playing this out. And there you have it. That concludes this video. It was a short and simple one, but it is one of the most powerful confluences you could use in your trading. So don't underestimate this divergence, and remember, it should be used alongside your trading plan and in line with higher time frame direction. Thank you guys for watching. If you have any questions and or suggestions for future videos you would like to see, then leave it below in the comments. Make sure you like and subscribe, and I will see you guys in the next one. Take care.